Ah yes, the endless quest of spotting the market bottom. Who wouldn't have wanted to go all in on the 6th of March of 2009 when the S&P bottomed after the Great Recession? From the bottom in 2009 to the peak at the start of 2022, you'd have more than 7x your money. I bet you're already thinking about the color of your Bugatti. It's a nice dream, right? Well yeah, because it's just that. A dream. Timing the market rarely goes your way if you're just focused on finding absolute peaks and bottoms. But there are actual ways of getting a feel of the current market situation, and I'm going to show you a few of them. Again, you can never 100% time a bottom, that would be like finding a needle in a haystack, but at least you should get a sense of when to ramp up your investments and when to scale down. Now let me also tell you exactly why simply buying the dip doesn't always work. And you might think, well, wait a minute, you just said we can't time the bottom, so why isn't dollar cost averaging or buying the dip good either? I am just going to show you what I mean. This is the weekly chart of the Nasdaq during the dot-com bubble crash. I can point out 4 distinct bear market rallies that took place well before the actual bottom. These were rather aggressive rallies, the first two around 30% and the last two more than 50%. In fact, this is the exact point Michael Burry made when asked if we were still in a bear market when the S&P rallied 20% from its local bottom. And what do you know? We're still in a bear market. Now in the really long term, you will likely make money just the same, but let's be honest, who wants to wait like 15 years just to break even because they bought the peak of the dot-com bubble? Alright, let's see the first indicator, and that is margin debt. This is the amount of money borrowed by investors with interest in order to long or short securities. Now most people will probably tell you to stay away from margin or leverage if you're unexperienced, and they are right. When margin debt rises a lot in a short period of time, it indicates that the market is a lot riskier because valuations are being propped up more and more by debt. And when prices start falling, we might see liquidation cascades. That's what happens when multiple investors receive margin calls and lose their positions, causing sell pressure which liquidates other investors and so on. Margin debt rose more than 60% in 12 months only 3 times in recent history. First, in 2000 before the dot-com crash, second in 2007 before the mortgage crisis, and third in 2021. This is actually sort of a peak indicator, but what the first two events have in common is a drop of 50% or more in price. This sounds a bit weird, but in a sense you could say that this indicator reflects investor emotion pretty well. People get greedy, borrow a lot, leading to a crash, and then fear takes over and fewer people borrow until the cycle repeats itself. The second indicator is more straightforward, and that is the forward price per earnings ratio. It uses future earnings, and this is where it differs from regular PE. It accurately predicted the S&P's bottom during most market declines since the 1990s, and so far bottoms fall when the forward PE ratio was between 13 and 14, with one big exception, the Great Recession of 2008, when valuations stayed low for a longer period of time. So what does this really tell us? Well, these indicators or any other that you might prefer will never be 100% accurate. They won't identify the exact bottom, but what they can do when used properly is that they can indicate a decent period to buy. Can your assets fall even more in the short term? Absolutely yes, but in the long term it should become apparent that it was in fact a decent period to buy. So I guess my point is that timing the market and going all in just isn't going to work, but it doesn't mean that you should just DCA without caring about market conditions. In reality, the best approach probably lies somewhere in the middle, investing in stuff that's not incredibly overvalued with a long-term approach in mind. Nothing you've seen here was financial advice. Thanks for watching, and please comment your thoughts below, like and subscribe for more, and make sure you check out this video about the current market decline.